Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
Clients hire for two reasons: protect their capital and create income streams they can't outlive. It's real simple. I mean, it's complex to get there, but it's two mandates. Protect my money, David. It's all the money I'm ever going to have, and make sure I have lifetime income.
Why don't more people do that?
I don't know.
Why don't more people do that?
Most of us have saved what we save, right? My average client's probably 65, 67 years old. They've saved what they've saved, right? So really it becomes about optimizing that amount of money we have and what is possible with the cash flow we can produce. As I always tell clients, when we do our second opinions, I promise you one thing: you're going to learn things you didn't know that you didn't know. Right? And those are the kind of things that blindside us. In real estate, you can do what's called a 1031 exchange, which creates no tax. You can actually do an exchange of stocks inside of an ETF, and there's no tax on that transaction. So they're much more tax efficient, which is a big deal, especially in a taxable account.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
We have 30 minutes of great information just for you.
Don't go anywhere. The show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions into us from all over Greater San Diego, and we answer them right here on the show. David, I have some great questions this week, and I'm going to begin from Anna, with Anna from La Jolla, and she writes, I don't want to take much risk any longer, but my broker doesn't seem to listen. I don't think he tries. He makes me feel dumb for feeling scared. I've lost a lot of money in the past, and I'm worried about it. I feel intimidated by my broker. He kind of acts like my dad. What should I do?
Well, Anna, thanks for the question. Yeah, I'm kind of laughing because, I know that feels like a little intimidated, right? And I hear that a lot. You know, it's kind of talking over your head and you don't understand this, just trust me. And we don't want to do that, right? Trust but verify, right? Facts first, opinion second. So we want to make sure, first I would do is talk to somebody else. Get a second opinion about what you have and at least have somebody talk English to you, right? First thing that we do for our prospective clients is we got to teach them what they got first, right? In English, 5th grade level, right? I have a giant whiteboard size of a wall in my office and we use that majority of the time, not the projector, not the spreadsheet. So, get educated on what you own, the risk you have by somebody that cares, that can take you through that. Because in order to make an informed decision, most people don't understand what they have first. And part of that's that dynamic you're talking about of feeling intimidated by the advisor that maybe, thinks he's a little too smart for you. So definitely get a second opinion.
Yeah, and I would say to Anna that your instincts are telling you something.
Yes.
If they're not making you feel good and providing you with the right answers, then clearly it's time for a second set of eyes. My next question is from Colin in Poway, and he writes, we're both 65 and we owe $150,000 on our home with a payment of $1,250 per month. If we maintain our current status, we'll have it paid off by 77. Our financial advisor told us to refi over 30 years to lower our payment to $725. We have $1 million in our IRA asset, $1 million in a non-IRA asset. We want to use $150,000 of the non-IRA asset that our advisor is managing. But he says that's a terrible idea. What do you think?
Well, thanks for the question first, but I think that you're getting bad advice. I mean, I hear this a lot. What happens is the firm doesn't want to get rid of the money because they don't want to lose the asset. Happens all the time. Just doing quick math, basically that advisor has to produce a 10% rate of return. If you have $150,000 at 10%, basically it's $15,000 a year. That's what it's costing you to make that mortgage payment. Pay off the mortgage. It's simple, right? Unless the math is like it's costing you 2 or 3% and you can outperform that. But once it gets over 5 or 6%, the cost of that mortgage relative to the value of the asset, we want to make sure we pay that off. So debt is one of the pillars of successful retirement planning, is having no debt. So that's a no-brainer. Pay the debt off.
Great. My last question is from Ben in Solana Beach, and he writes, I have an MBA, David, understand investments and handle our portfolio. I've always done okay. But now I'm 70 and I don't have the same passion for it anymore. I worry about it more and more every day. My wife is actually worried about my worrying. In your honest opinion, is there really any reason for me to work with an advisor?
Well, absolutely, and thank you for the question, because at a minimum, talk to somebody, get a second opinion on what you're doing, just to learn some things. I always tell clients, when we do our second opinions, I promise you one thing, you're gonna learn things you didn't know that you didn't know. Right? And those are the kind of things that blindside us. So good job managing your money. You've probably done a really good job. But the fact is, what I say, a lot of clients will hire our firm in particular just because they don't want to deal with the assets, or more importantly, they're concerned if they're not there anymore, who's going to take care of the other spouse, right? The surviving spouse. Now, most times it's the man that's handling it. Not my wife's a CPA. She deals with all the finances of the household, right, in the business. So it doesn't matter. But the fact is, we want to make sure that we have planning in place, or somebody that you trust that can make sure that your spouse is going to be taken care of. That's the most important.
David, thanks so much. If you want more information about anything we spoke about here today, hey, pick up the phone right now and give us a call, or go to our website. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Welcome back to the program, San Diego. We're here on AM 600 with the retirement architect, David Reyes. David, we got a great topic today, and we're going to be talking about mutual funds versus ETFs. This is something that comes up quite a bit.
Yeah.
And, they're relatively similar, but there are some big differences between the two. Hey, let me just go ahead and say that David is a best-selling author, TV personality, and stick around because we're going to talk about a complimentary second opinion coming up where David is going to take a look at your portfolio. With the mutual funds and ETFs, probably the biggest thing, David, in there is fees, right? There's a large discrepancy between the two products. And by the way, let me do this.
Yeah.
What's the real difference between the two? If I'm going to take their fundamental elements, they're relatively similar, right?
Yeah, but that's like, I don't know. I wouldn't say that. But yeah, it's similar, but that's where it ends.
That's what I'm asking. You're the expert, not me.
Yeah, it's because they're just night and day. I mean, the ETF is probably one of the greatest inventions ever, quite honestly. One of the great neat things about it is that they're very tax friendly. And here's one of the reasons why. In a mutual fund, when they buy and sell a stock, right, they can create a taxable event. This is kind of a nuanced thing that's super important, a little techie, but it's important to know. Because one of the benefits is they're a lot less expensive in most cases, right? Significantly. Like can be 95% less expensive, right? Where you could have maybe one mutual fund's 1% fee and it's 0.05 or 0.03 in an ETF. So significant difference. But one of the reasons the taxes are better in them is because the mutual fund has to buy and sell a stock. It creates a capital gain. Make sense, right? Then inside of an ETF, they have they can exchange stocks. So what happens, they can say, okay, I want to sell this stock and buy that stock. Instead, they can exchange a Google for an Apple. Mm-hmm. Right, and that exchange, like in real estate, you can do it. It's called a 1031 exchange, which creates no tax. You can actually do an exchange of stocks inside of an ETF, and there's no tax on that transaction. So they're much more tax efficient, which is a big deal, especially in a taxable account. Right?
I had no idea about that.
Oh yeah.
And does that happen automatically, or do you have to request it?
No, it's just that the fund manager who's running the ETF, some are going to be more stringent about how they do that. But in general, you can say across the board, ETFs are more tax efficient. You can make that statement. Some are going to be even more, where their kind of mandate is we want to generate no tax at the end of the year. So they can be very significantly different, both on the fee structure, but also from the tax perspective.
Wow. So because I know we've talked about scenarios before with the mutual fund where it actually went down in value, but because of the trading that took place inside, there was a taxable event, but you actually lost money and you paid taxes.
Isn't it crazy?
On the fact that you lost money.
It happens, especially when markets crash because people are redeeming stock. Yeah. So then when they sell the stock, they have to sell stock inside the mutual fund, and then it generates a tax. So insult to injury. You lost 20% and get a capital gain tax on your loss.
And that brings us right to the next topic here, which is taxes. And goodness, it seems like the ETF a lot more tax friendly, right?
Absolutely. Yep.
And then the last piece here is liquidity.
Yeah.
Okay, and I think this is really important because most investors like to be able to say, If I want to get at my money, I want to get at my money.
Exactly,
right?
exactly. Yeah, so the difference in from a sales perspective, from selling, is that a mutual fund's end of day close. So you can sell it anytime you want. You can say push the sell button, but it won't trade until the end of the day. So let's say you're in a bad market. We've talked about this before in other shows where the market's crashing and you say, okay, I'm out, I want to get out. Well, let's say the market was down 5%, right? At the opening of the day, you want to get out. You sold your mutual fund. Well, it ended down 10%. Guess where you're at? You lost 10%.
That's a big deal.
The ETF, because it trades like a stock, it's fully liquid. Like if you bought Apple, you could buy an ETF. You sell it the second you sell it, then you're redeeming those shares at that time and going to cash. So in a volatile market, if you're really trying to get out of the market, which is most times markets are not crazy like they have been, but they can be. That's where it really can pay off to have.
So I'm going to ask a nerdy question here because you talked about the mutual fund. So after the bell rings, that's when it can sell. Who's selling them at that time? The bell just rang.
Yeah,
right?
Well, they're just closing. It's just the trade gets closed at that point in time because they own securities in there. So what happens, they just get all sold at the end of the day, right? Because that's a basket of stocks. Let's say it's a stock mutual fund. Let's say there's 100 stocks in there. Well, those stocks all just get sold at the end of the day.
So when you do a second opinion on someone's portfolio, do you see a lot of times that there's more mutual fund, and I'm not talking about 401ks, I'm just talking about outside of 401ks, because clearly we know those are mutual fund based. Do you see a lot of people using ETFs now, or do you kind of look and say, geez, we could make some changes here? And I know I'm doing it very 30,000 foot level here, but
majority of clients own mostly mutual funds.
Yeah.
Yep. Because that's what they're used to. And unfortunately, it's what especially the big box, retail banks and institutions that you know of, they love them because they actually they get fees, they get kickbacks from the mutual fund companies I've talked about before. So they actually have their little, it's like they call it shelf space. So actually you have to pay to be on their platform. The mutual fund company has to pay, typically sometimes the bank, to be on their platform. And then typically those actually have higher fees as well. And the bank's getting compensated from the mutual funds, and they're also charging the client a fee.
Okay, that's sketchy. But I've seen the articles.
Oh yeah, it's real.
Somehow this is allowed to take place, and I've got about 30 seconds left here, David. So I think it's important to point out your boutique independent fiduciary advisor. What's the real difference between suitability and the fiduciary standard?
Yeah, suitability just means is the risk appropriate for the client, right? It's the lowest standard of care. The highest standard of care is a fiduciary standard, which basically means that you have to act in the best interest of your client, across the board.
Legally.
Right? It's a legal standard of care. It's a legal standard of care.
Because if you're a fiduciary and something doesn't go correctly, there is the potential of legal action.
So real life is, so let's say you're an advisor, not a fiduciary, you're using a suitability standard, and somebody buys a horrible product. But it was financially suitable, but it was a horrible product, there's no recourse.
Yeah.
Right? It could be the worst. We talked about unit investment trust. We talked about these fee-heavy products, these fee-infested products. They could be horrible, but if it's suitable for the client relative to the risk, the client can do nothing about it.
Yeah, that's a very vague
We have a higher standard
term.
of care, for sure. Yep.
David,
and we
thanks
want
so much. If you want to have David review your portfolio, it's absolutely complimentary, a second opinion with David's eyes himself. All you have to do is give him a call in the office. That's 866-REYES-PLAN, 866-REYES-PLAN. Visit him on the web at reyesplan.com. And don't go anywhere, San Diego. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, and welcome to this week's Retirement True or False. David, I've got some goodies this week. My first question to you, sir, is ETFs and mutual funds are the same product with different names, true or false?
That would be false, absolutely. Yeah, that's another one of those confusing things. I feel bad for people out there trying to figure stuff out because, what's a mutual fund, exchange traded fund? This is gobbledygook, right? And so the major difference is that most people know for mutual funds because that's all their 401k plans have. And most people's experience is investing in their 401k plans. That's where they've saved all their money. And so what happened many years ago in the 90s, ETFs, exchange traded funds, think of the same, it's a fund. It owns stocks or bonds, or a combination of. Instead of a mutual fund, it's called an exchange traded fund. What's the difference? Mutual funds, highest fees, higher fees, worse tax treatment, and less liquid. Okay, ETFs have more liquidity, lower fees, and better tax treatment. Okay, without getting in the weeds with it, there's lots of reasons for that. But the fact is that, again, as a firm, we rarely, if ever, use mutual funds because of the cost and because of the tax treatment and liquidity. For instance, right, let's say the market's crashing like it was during COVID, down 10% in a day. If you own a mutual fund, you can't sell till the end of the day. You own an exchange-traded fund with the same stocks in it, I can sell just like a stock, boom, done. That's just right there.
That's a big deal, by the way.
Huge.
Can't sell it
during the day.
Till the stock market closes.
End of day.
Crazy.
Yep, so that's just that alone, right? Now, most markets, that's not that important, but when you have scary markets like we've had, and you say, I'm done, or the advisor wants to get out of that position, they have to wait till the end of the day.
That's an enormous distinction because, most people watching are not in financial services, David. They do something else for a living, and it's always great to get a little bit of knowledge on how I can make the pathway to my retirement, or if I'm in retirement right now, make that pathway nicer. And ETFs would certainly be something for consideration. Fair statement?
For sure, absolutely.
Next question is, one bad year can have a dramatic effect on your retirement, true or false?
Absolutely, absolutely. I've seen it firsthand. 2007, 2008 comes to mind. I mean, that was terrible. Between the the financial crisis and the housing and the stock market, 401ks. I mean, it was bad. That was the worst time. I mean, COVID was so fast. People are, kind of whipsawed. But yeah, I mean, absolutely. That 1 year, it took from 2007, 2009, the market dropped 55%. It took to 2013 to get back to new highs. So 5 years. The problem with that is you're spending down that. You need that 4 or 5%, 6% of your portfolio. You're going to probably run out of money because now you're not only adding losses, but also taking distributions. So 1 year can for sure be a problem.
Yeah, and that the whole concept of sequence of returns, which I'll ask you to explain in a moment. If you retired in 2006,
yep,
your year 2, essentially, and year 3 of your retirement were beat up, and now you're no longer adding money in. You've received the last paycheck you're ever going to receive, and you got put in a hole, as opposed to maybe someone who retired at a different date and had their first 3, 4, 5, 6, 7 years increase.
Yep.
That is the whole concept behind sequence of returns, and nobody has a crystal ball, just like you said.
It's luck. It's
Nobody
luck.
saw
When did you
COVID
start?
coming. But every 3, 4, 5, 6, 10 years, whatever, there's going to be a COVID, I'm not talking about a health scare, but something that's going to trigger the markets to have a downturn, and in some cases a serious downturn, right?
Absolutely, absolutely. Think if you retired in 2007 versus 2009, right? March of 2009 was the bottom.
Yeah.
You're like a rock star. Oh, I did great. If you were 24 months difference, you could have the difference of running out of money or having excess capital during retirement.
And you don't know. And I got to get into this too, because I see that, I hear that, and a part of me gets a little anxiety, right? Because nobody knows. They have their retirement date set up. That's when they're going to retire. But if you plan properly, David, you can set yourself up in a manner which, even if the stock market has wild fluctuations, in particularly downward, you can be protected, right? If you're a more conservative retiree investor, you can do things, and I'm not going to ask you to get in all the strategies right now, but true or false, you can protect yourself from these things going forward.
Absolutely. Clients hire for 2 reasons: protect their capital and create income streams they can't outlive. It's real simple. I mean, it's complex to get there, but it's 2 mandates. Protect my money, David. It's all the money I'm ever going to have, and make sure I have lifetime income.
Why don't more people do that?
I don't know.
Why don't more people do that?
Don't tell anybody. I want to keep my job.
All righty, last question. You should consider being less risky with your investments in retirement. True or false?
Absolutely true. Yes, absolutely. And that's a mistake. The first thing we do, part of our second opinion process, is a risk assessment, right? Because people have no idea what kind of risk they have in the portfolio, right? Because they're told just buy and hold, and if the market goes down, don't worry, it'll come back. That's what the institutions have trained you, because they don't want you selling their assets. The dirty little secret, I call it, on Wall Street, they don't get paid for cash, right? So that's why you never sell, right? Because if you sell, let's say you want to go half cash. Say, Mark, okay, you call your broker, say, I want to go 50% cash. They're going to talk you out of it till till you finally say, okay, uncle. Because the problem is, once they do that, they no longer can charge you asset management fees on that particular part of the portfolio. So there's times when you want to have more cash than others, and cash is an asset class for us sometimes. We want to have more dry powder and be a little more conservative. So sometimes you want to have some cash in the portfolio.
Yeah, and I'll go one step further here. We talked about it before. You can't make up these big losses. And how often do you see this? Somebody comes in, I'm going to make up a number right now, David. They have $1 million.
Yep.
And you ask them, are you comfortable with the stock market swing of 20%? Oh, we're okay with that. Well, that's $200,000. Oh, 200,000. Now, 20% is a little tiny number, right? But when you really put 200,000 of your hard-earned money, now that's the number. Wait a minute. No, maybe I'm more comfortable with 8 to 10%. And you can put together a portfolio that will fluctuate downward 8 to 10%.
Absolutely.
Fair statement?
Yeah, absolutely. And you just have to fine-tune things. I mean, that we're going to manage, first we're going to manage the money. What's the cash flow we need, right? That's always the first question. And then how do we build, again, we want the most amount of income, least amount of risk, never run out of money. Again, most amount of income, least amount of risk, never run out of money. That's kind of competing factions, right? So we want to build that portfolio. So if somebody wants that kind of that lack of risk, that little volatility, you're going to have to use some investments that have some principal protection, maybe some lifetime income, pension type investments. They are available, and they're things that we use all the time. So that's going to be kind of the regulator, so to speak, of what their max risk tolerance is, what their max drawdown, the number, not a percentage. David, I got $1 million. I don't want to lose more than $100,000. Well, that's going to tell you right away that we need to start going into some different places than the stock and bond market alone.
David, thank you so much. If you want more information about these great topics, it's really simple. Give us a call today, set up a complimentary second opinion, 866-REYES-PLAN, or go to our website, reyesplan.com. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866-REYES-PLAN for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Today I want to talk about the critical questions you must have answered to have a successful retirement, a safe retirement. So one is, when can I retire? And I don't mean when do you want to retire, when can you safely retire without running out of money? Do I have enough saved? Well, most of us have saved what we saved, right? My average client is probably 65, 67 years old. They've saved what they've saved, right? So really it becomes about optimizing that amount of money we have and what is possible with the cash flow we can produce. Can I guarantee I won't run out of money? Well, the only way to guarantee is we can put a certain amount of your money in guaranteed investments, typically annuity contracts, things like that, lifetime income benefit contracts. So we'll use those in some cases with clients, but again, guaranteeing you can't run out of money. The point is that there's only certain products that we can use to do that as a piece of the portfolio. How much can I safely withdraw? This is a big one. There's an old rule called the 4% rule. Most people feel like what they've read is 4% is a good number to take out. If you have $1 million, $40,000 a year. What we're going to determine is kind of reverse engineer that and say, okay, here's how you got $1 million, right? What can we safely withdraw? I'll tell you, as a firm, we're going to be in the 5% range for safe withdrawal rates for our clients, which is actually pretty high. According to Morningstar, if you have a 60-40 portfolio of stocks and bonds, you can only take out less than 2%. So we know retirees need about 5% due to inflation, taxes, those types of things, healthcare costs. How long will my money last? Well, for our clients, that money's got to last their lifetimes plus, because most of us want to not only have the lifestyle we want to have, we want to leave money to our children as well. How much will I lose in the next market crash? One of the things we're going to do with all of our clients do a stress test. We're going to measure what would happen if you were invested like you are today during the 2008 financial crisis, during the 2020 COVID crash, during the 2000 tech wreck. And we can actually look and say, here's how your portfolio would react or how it reacted, and is that appropriate for your risk? How much taxes will I pay? So one of the things we're going to do for sure, my partner's a CPA, taxes are a big piece of it. It's a cost, it's an expense. And I don't know about you, but I think taxes will probably be higher 10 years from now than they are today. And so the fact is, we need to know what our net income is. The first question I ask all clients is, how much is your net income from your paycheck? What gets deposited into your bank account, right? We need to know what our net income is going to be. So important question. Can I reduce my fees? We do a fee assessment for all of our clients in our initial review process. Most of you are paying a lot of fees, especially if you own mutual funds. Can I start spending some of my money, right? Well, that's the big piece, right? Most people are great at saving, but it's really intimidating to spend money. So part of what we're going to do in that process, we're going to make sure that we have a written retirement income plan for you, and we'll tell you specifically how much money you can take from your investments. And number 11, what if my spouse passes away? That's probably the biggest concern I have for clients, because for sure, if one of you passes away before the other, which is going to happen most likely, you're going to lose a Social Security benefit and or possibly a pension if you have one. And that's the biggest piece of overlooked planning that I see that we want to solve for. We want to focus on the most at-risk spouse, whether it's the husband or wife, and make sure we know exactly what we can spend in retirement, including the loss of pension, to make sure that the quality of life is not changed because one of you passes. Typically, we need about 70% of the income, doing this for a long time. So per $100, I need $70 if my spouse passes away. Not half. It's not half, I can tell you that. Let's say 70%. So that's a big piece of planning that we want to make sure that you have in your plan. And kind of finally, can I leave money to my beneficiaries? Now, I know how much you love your kids. I got 3 of my own, but the fact is that's not the first priority. The number one priority is we want to make sure that you and your spouse, the life that you want to have in retirement. But we also want to know, hey, how much money can we expect to leave to our children? So all these are issues that we answer for all of our clients, and I find that most people have not gone through a comprehensive process like this. So if you want to reach out to us and get a complimentary second opinion and have these questions answered for you, give us a call or go to our website.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, hey, pick up the phone and give us a call in the office at 866-REYES-PLAN or visit our website.
And remember, you retire once, we retire every day.